Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in a half hour's time. Let's get to the stories we're following out of the BNN Bloomberg newsroom. The U.S. President Donald Trump threatening to impose tariffs on Canadian fertilizer. Trump was announcing aid for American farmers when he said the U.S. could impose very severe tariffs on fertilizer if necessary. The U.S., of course, relies on Canadian potash, so a tariff would be a hit to U.S. farmers. We are keeping track of shares of Microsoft today. The tech giant announced it's spending $19 billion in Canada between 2023 and 2027. The company will focus on AI infrastructure with new capacity set to come online in the second half of next year. Home Depot shares down today after it forecasted lower comparable sales growth and profit for 2026. U.S. housing demand has been choppy with rising unemployment and high home prices. However, Home Depot expects the pressures in housing to correct and provide the home improvement market with support. Shares of Campbell's falling today. The food and beverage company posted lower profit and revenue for its latest quarter. Campbell says at-home cooking trends continue to benefit its meals and beverages division. However, the snack business continues to face soft demand. The American company will acquire a 49% interest in La Regina, the maker of Rao's pasta sauces. Campbell's also reaffirmed its full-year guidance for 2026. Here is where we are in the markets right now. The TSX Composite up 89 points today to 30,259. And in the U.S., not a lot of movement for the S&P 500. The Dow Jones dropping 163 points on the hour today, and the Nasdaq up 30 points right now. The U.S. President Donald Trump threatening tariffs on Canadian fertilizer in order to bolster domestic production there. We have more on this and what it could mean with Joshua Linville, Vice President of Fertilizer at StoneX Group. Thanks for joining us today.
Thanks for having me.
So there was outcry in the U.S. in the spring when a higher tariff was applied to potash. So does it even make sense to revisit?
Well, unfortunately, this is going to be one of those things that U.S. farmers will suffer because of it. The U.S. is very dependent on imported potash. Now, for the longest time, this wasn't an issue. Canada is the largest supplier, exporter of potash in the world, and it's not even a close second. So as long as we stayed on good terms, we had plenty of supply. But if all of a sudden we take measures to block or slow those imports, well, we got to start looking at different places. And our second biggest supplier has been Russia. This is going to be something we got to watch very, very closely.
Okay. Does the U.S. have accessible supplies in its own country of potash to satisfy any sort of demand?
We do have reserves and we do have production. The problem is current production falls far short of what our overall demand is. That's why we're still bringing these imports. And could we increase our production? Absolutely. And there are works going on to try and increase those production flows. But these aren't things that are measured in days, weeks, months. It's the things that are measured in years. So in order to start supplementing what we're basically talking about cutting off today, that's not something we could do relatively quickly. It would take several years before those mines become operational and send the first ton to those farmers.
Okay. You mentioned Russia, for example, as another alternative. Belarus, I believe, is the other one. Has the U.S. ever turned to either of these countries for supply of potash?
Actually, yes, that's a very normal supply. When you look at the U.S. imports on a yearly basis, about 88 to 90% of those flows do originate from Canada. But our second biggest potash supplier is Russia, and about 8 to 10% of our overall imports come from Russia. And then you start to break it down. They are our single biggest urea supplier, our biggest UAN supplier. And so across the broad spectrum of major fertilizers that the farmer uses, Russia's up there. They are one of our bigger participants.
With what is going on in the U.S. right now, and we saw the rollout of aid today for American farmers, would they be able to withstand a price increase in potash?
If they withstand it, yes, they can likely survive. The subsidy payment will help. It's going to help bridge a little bit of the gap. But a lot of people are going to look at that and say, well, that falls far short of what I've had to deal with. my inputs, not just fertilizer, my inputs overall are significantly higher price than what normal is. My grain prices are significantly lower. So yes, the subsidy payment is going to help. It's going to give me a little bit of cash flow, but it fails to come anywhere close to actually solving the equation with these farmers. They're stuck in the middle of this war on their inputs and their outputs.
How widely used is potash in the U.S.?
It's going to depend on where you're at regionally, but for the most part, it is. When we look at fertilizers, there's 5 major fertilizers that we cover, and potash is absolutely in that biggest group.
Okay, so it's widely used across the U.S. Are there alternatives? You mentioned there are other fertilizers that are in that group. Could it be replaced by something else?
Unfortunately, when you look at it, the plant needs things like phosphate, potash, nitrogen, of course, all the micro fertilizers that are out there. So unfortunately, when it comes to potash, there's not really a secondary backup product out there that can all of a sudden just be entered into the marketplace to take up that demand, that potash to grow that crop for 2026.
All right. Joshua Linville is Vice President of Fertilizer at StoneX Group. Thanks for your time. The Federal Reserve announcement set for tomorrow. How are investors bracing themselves? More in a moment. The American market seemed to be on hold with the Federal Reserve rate decision coming tomorrow. Let's go to Adam Turnquist, Chief Technical Strategist at LPL Financial. Thanks for joining us today.
Hey, good afternoon. Thanks for having me.
With most already expecting a rate cut, do you anticipate any kind of market rally on the news tomorrow?
Potentially, it's all about the messaging when we get the updated summary of economic projections. What are policymakers penciling in for the Fed funds rate next year? Also, what are their inflation forecasts? Consensus going into this meeting is for a hawkish rate cut, meaning the messaging might sound a little bit more hawkish and might not get as many rate cuts on the summary of economic projections as anticipated. The fixed income market has priced that in. We've had this big rebound in interest rates in the U.S. with the 10-year getting close to 4.15, 4.20, some important levels to watch. We'll see what happens and plays out tomorrow. The options market looking at maybe a little over 1% move on the news, but it's really going to be all about the messaging. I think the rate cut is priced in. It's just a matter of how dovish is Chair Powell going to sound tomorrow.
Yeah. What are you watching for in the remarks? What do you want to key into?
So when you look at the dot plot and the projections, how much consensus there is within that dot plot, where's the disagreements? I think it's going to be pretty scattered. When you look at the last few summary of economic projections, there's little consensus about how to manage interest rates. The other one is inflation. How is the Fed viewing some of the moves we've seen in commodity markets, tariff pass-throughs starting to show up in some of the goods components of inflation? How are they viewing that in the context of rate cuts in this softer labor market data that we continue to see?
Okay. Do you feel the markets are more influenced now by monetary decisions than they have been in the past?
I think so. When we look at just the day-to-day noise, we've had so many Fed speakers out with varying views, especially when there's a Fed chair position up for grabs for some of those officials. Certainly a major driver of performance. Fundamentals, of course, matter, but when you look at policy, and that's part of our outlook for 2026, it's just this policy engine, whether it's monetary policy or fiscal policy, they seem to be in the driver's seat right now, along with just momentum in the market, especially in 2025.
The markets, of course, have had a volatile year at the start of the Trump term. The reason for a big part of that. Do you anticipate that volatility to carry on into 2026 and for the same reason?
We think it will be a volatile year, above average volatility, we'll call it, for 2026. That's what history tells us. We have a midterm election here in the U.S. coming in November. Typically, the market does not like uncertainty, so that midterm election leaves the market with a lot of question marks about the composition of leadership in Washington. You typically have the most volatile year during midterm years out of that presidential cycle. We'll call it below average, but still positive types of returns. So we think that volatility will be present throughout 2026. The good news, though, for investors, volatility often brings opportunity as well for investors. We think maybe you'll get a chance to buy the dip in this bull market in sometime in 2026, maybe in the first quarter.
But you don't think necessarily that trade issues will continue to dominate?
Unfortunately, I don't think they're going away. Maybe they won't be as pronounced as we'll call the Liberation Day period, but I don't think they're going to go away. And I think that's going to be reflective in volatility, not just in equity markets, but that plays into the macro when you think about fixed income. Look what the US dollar did this year, the worst first half since its inception in the 1970s. And you think about just the broader implications of trade uncertainty and how that can impact markets. We don't think that's going away in 2026. It's still going to be running in the background, maybe just not as noisy as this year.
Okay. Are you staying invested in AI big tech? Are you moving some of the money towards other parts of the build out?
We're constructive on the AI big tech theme. When you look at the CapEx cycle for this year and next year, estimates right now is that you're going to see just the hyperscalers, so the big companies building out those AI data centers, over $500 billion in spending. Those companies are spending about a quarter of their revenue now on CapEx. It's broad, it's global. We don't see that slowing down when you look at the trends, just the headlines, how many investments are going out around the globe in terms of AI. And they're holding up on margins as well. When you look at the returns on some of the margins, expectations, you look at Microsoft, for example, their gross margins still running at 67, 68% for 2026. Some of the other hyperscalers showing very good margins. So it will be a show me story, though. What's the quality of spending on that CapEx related to AI? What's the productivity gains that we're seeing? And of course, just the overall return on investment. I think that's going to be the big question mark in 2026.
I think that question has really sort of sucked out investor enthusiasm, right? Are you think investors are demanding too much too soon?
I think what investors are looking for is just consistency. What's the quality of the spending? And I think they've been a little bit surprised here by the reaction. If you flash back over the last couple of years, all it really took for the market to react positively was a big announcement on spending on AI. Now there's more scrutiny on that as these companies increase debt and they basically load up their balance sheets with added debt. That brings volatility. And there's just more dispersion in performance within these names as well. If you look at the Magnificent Seven, for example, monthly returns are becoming more and more wide. I think there'll be bigger discrepancy as well next year when you look at the dispersion between the winners and losers on the AI spend.
All right, Adam, I'm going to leave it there, but appreciate your time. Adam Turnquist, Chief Technical Strategist, LPL Financial. Coming up next, the Federal Reserve expected to cut the benchmark rate for a third consecutive meeting tomorrow. Investors, of course, are watching this. We'll talk to an expert about what will come in the new year. Back in a moment. And this just into the newsroom. Bloomberg reporting SpaceX is going to move ahead with plans for an initial public offering that would seek to raise significantly more than $30 billion. So this is according to people familiar with the matter. It would make it the biggest listing of all time. Elon Musk-led company is targeting a valuation of $1.5 trillion for the entire company. SpaceX's management and advisors are pursuing a listing as soon as mid to late 2026. The timing of the IPO could change based on market conditions and other factors, and one of the people said the timing could slip until 2027. A representative for SpaceX did not immediately respond to a request for comment. And a reminder, it comes after the CEO, Elon Musk, on the weekend walked back comments that SpaceX is trying to achieve an $800 billion valuation. The U.S. Federal Reserve will announce its last rate decision of 2025 tomorrow. Most are banking on a rate cut. Let's discuss with Thomas Honig. He's former chief executive of the Federal Reserve Bank of Kansas City. Thanks for joining us today.
Thanks for having me. Good to be with you.
Is the data to date weak enough to support anything more than a 25-point cut?
Well, no, I don't think it is. In fact, I think the data would be in the play in the conversation today and tomorrow, whether there should be a cut. But the odds-on favorite is that there'll be 25 basis point cut, but I doubt it would be larger than that.
Okay. The official data, of course, has been slow to come because of the government shutdown. Is there a concern that the Federal Reserve doesn't have the most updated information?
Well, I think that's always an issue. But even when you have the updated information, it's often revised. They are relying on a fair amount of private data sources this time, and also the Federal Reserve has a pretty good network for information gathering in the regions and so forth. So they have enough information to make a decision, and I think be confident in the decision relative to each taking their position, each of the members taking their position. And I think there is a lot of discussion within the FOMC today just on, whether they should cut. So, I think there's enough information. I think the conversation is healthy.
What is the most critical information that you have seen?
Well, I think recently the PCE inflation index came in 2.8. That means inflation, at least in September, was staying around the 3% number. There's been no evidence that it's coming down from that recently in any of the private data. So I think that's the most important. The other is the continued issues around employment. The initial claims are still, I think, showing that the job market is relatively good, so they don't have to worry about 50 basis point cut. And those two are what they usually focus on. And thirdly, I would tell you, the consumer data, the post-Thanksgiving data here in the United States, that was very positive. That means the consumer is still in the game, so to speak. And so that's also gives you pretty good confidence you don't need to do more than a 25 basis point cut at that. And I doubt, I would imagine there's a good deal of discussion inside on whether there should be any cut, but the compromise will be 25 basis points.
Okay, so we knew that the Federal Reserve's focus of late has been jobs and weakness in America in the jobs or the labor market. I'm just wondering whether you think that has shifted more towards inflation at this point.
I doubt it. There may be some who've moved a little bit more in the inflationary concern, but that element will wait to get the next set of data before they change their mind or change positions.
Okay. What will you be listening for in the remarks from the chair?
Oh, I will be listening very carefully in terms of how they frame the decision, how much compromise was in the decision, if he'll talk about it, because that'll give you a hint as to what the next meeting will look like. And then I think he will say some things about, the committee was, willing to hold off. They'll look at the data next time, and we are worried about inflation. And he will reemphasize that he's committed to, or the FOMC is committed to the 2% inflation target. And that's why they're willing to wait and see before they make any more, any kind of guidance in terms of the next move.
Okay, so let's also talk about the compromise situation, because, of course, Jerome Powell will leave his position in May. Are you worried about independence for the Fed into 2026?
Yes, I am. Whether he stays or go, I'm worried about it because there's a lot of pressure on the Fed to cut rates, to keep the economy booming, or very strong, if not booming, as we go forward from here. There's a very strong Wall Street influence here. They are looking for the cut, and they always, for the short term, benefit from cuts. So there'll be a lot of pressure on that. So yes, I'm going to be listening very carefully to what Powell says in terms of how they're thinking about January.
Okay, so can you just expand on the risk associated with that kind of pressure, where you have somebody in place who is less independent than history would have for the chair?
Well, the reason you worry about that is that on the margin, I mean, if it were clearly inflation is getting higher, it's very straightforward, then that's easy. And if things are really, if the job market is really poor, that's easy. But on the margin, on the delays, or whether given that inflation has remained elevated, then the public starts to think, well, is the new goal 3%? Are we satisfied with 3% inflation instead of 2%? He says he's committed to 2%, but are they really kind of satisfied with 3%? That's the kind of thing you get on the margin when you don't know how independent the central bank is, whether it's the Federal Reserve or any other central bank. It's that margin call. and how committed you are to your goal, which is 2% inflation, especially in an environment where the unemployment rate is still in the low fours.
Okay, so looking ahead to what to expect for next year, would you factor in what could be the stimulative effect of the new law in the U.S., and how does that weigh on where you expect the rate to go next year?
Well, it'll play some role, but I think the biggest issue for the Fed going forward is who the president of the United States picks for the next chairman of the Federal Reserve. That's going to be the most significant element. The new law, yes, we expect something from that, some stimulus, if that's what we're talking about. But the real issue will be who is the next chairman.
Okay, and typically what goes into assessing the chairman and who should be in that position?
Well, I think first of all would be credentials. What is the background? Do they have an strong economics background, a strong markets background? Do they understand the working of not only the U.S. but the global economy? Those will be some of the inputs that they have. Now, the other in the case of the United States will be, will they be willing to listen to the Congress or the president? How much influence will that have? That's going to be a factor, I think, in this selection, as has been made clear by the president of the United States.
Which historically, of course, it isn't.
Pardon?
Which historically, of course, it isn't.
It is part of the core decision.
Sorry, historically, what the president wants is not part of that decision, I would imagine.
Oh, that's right. What the president wants is part of the decision who the president selects. But what happens after that fact is very much dependent on the credentials, the independence of that person that they chose, and how they conduct their role as chairman. So any president, I mean, you look at history, Truman was very concerned about who was going to be the chairman. President Johnson was very concerned. Nixon was very concerned. Certainly Biden was concerned. So that's natural for the president. But the real test is, once chosen, how independent does that chairman act, and how independent can that chairman act?
Yeah. Mr. Honig, I've got to leave it there with you, sir. I'm out of time. Thomas Honig, former chief executive of the Federal Reserve Bank of Kansas. Thank you.
Thank you.
All right, a quick look at the markets as we head to a break, and the closing numbers straight ahead. Back in a moment. Here are the closing bells for the end of the trading day. At the NASDAQ, Remitly ringing the closing bell. In New York, Atlantic Union Bank shares to celebrate its Investor Day. You're watching The Close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX Composite ended the day 74 points up. The S&P 500, not a material change for that S&P. The NASDAQ today gaining 30 points, ending the day at 23,576. Let's get to the movers in Toronto. Commodities on the move today. In Toronto, Pan American Silver gaining more than 11% today. $6.68 move up to $67.05. Let's move on to Aya Gold and Silver, which gained almost 7.5%. It's up 39% on the year, ending the day today at $18.85. Let's go to Curaleaf Holdings. Curaleaf Holdings gaining 6% on the day. It's a cannabis company. That's a gain of 22 cents, or taking it to $3.76 to end the day. First Majestic Silver also gaining 7%. It's up $1.43. to $21.34, up 147% in the last year. And then Skeena Resources, 6.6% up today. It's up over 150% over the last year. Again today, $2.05. In the red today, Advantage Energy dropping 4% or 51 cents to end the day at $12.12. And then Ivanhoe Mines also dropping today about 5.5%, a loss of 77 cents per share, taking the shares to $13.30. Let's go to Bloomberg's equities reporter Stephanie Hughes for some more on the movers today. Stephanie, Canadian clothing retailer Group Dynamite shares spiking on solid earnings. What did they report?
Yeah, that's right, Marella. So the Quebec-based retailer Dynamite reported a beat and raise quarter before the markets opened this morning, and that prompted a stock surge of over 20% at its highest point. That was enough to bring the stock price to an all-time high. So to break down the numbers, the adjusted earnings of 72 cents per share came ahead of what analysts were expecting by nearly a 20-cent margin. The revenue and adjusted EBITDA also had a pretty healthy lead compared to what consensus was expecting. But what analysts and traders are really fixated on this time around is the fact that the company raised its fiscal 2025 guidance. So the company initially expected that its same-store sales growth would gain by as much as 19% over the course of 2025. They've now raised that to over 27%. So that's a pretty big move up in expectations. That and the adjusted EBITDA margin growth, they initially expected 33%. That's moved to as much as 37%. All the while, they're planning for fewer capital expenditures during the year. So the CEO, Andrew Lutfy, weighed in on this, saying that most of the company's tariff volatility is now behind it. He also pointed to consumer strength that's going to help the company ride that momentum and justify this guidance range or raise, I should say. And it's also gotten a thumbs up from the analyst community, including TD Cowen's Brian Morrison, who said that Dynamite soundly beat expectations and that the 2025 guidance raise implied attractive growth value for a company and would put it at a premium valuation, what the company said. So for Dynamite's part, it is a relatively newcomer to the markets. It started listing or publicly trading in the middle of 2024. But even so, this year it's had an impressive run. The last time I checked today, it had a year-to-date gain of over 340%. This is during a year when tariffs were causing some consumer angst. But apparently, Dynamite was able to sidestep that.
All right, let's talk about Pan American Silver, then also gaining today. On any specific news?
Yeah, so it's mostly because of a silver story. So Pan American Silver gained by over 11% at its highest point, also reaching an all-time high and rising in tandem with other silver miners. So that's because it's also its biggest intraday gain since April. So this happened after spot silver prices reached a record high today at just over $60 per troy ounce. And that's because of traders' bigger bets that the Federal Reserve will lower its borrowing costs tomorrow during its last interest rate decision of the year. It's also like silver has been far outperforming gold, more than doubling its own price. A lot of those gains have been made in the past 2 months as there's been a historic supply squeeze at the London benchmark market. A lot of that demand coming from India. And it's also just considered a play on precious metals that's coming in at a lower price point than gold, for instance. So it wasn't just Pan American Silver. We had other silver names on the TSX grinding higher, like Endeavor, Aya Gold and Silver, and a few First Majestic and a few others. So there was quite a few players among the top TSX, top 10 performers, Marella.
All right, Bloomberg, Stephanie Hughes, the latest in Toronto. Thanks, Stephanie. Appreciate it. Let's check in on movers south of the border. Bloomberg senior equities reporter is Bailey Lipschultz, and he joins us now to talk about that. AutoZone, Bailey, falls on an earnings miss. What happened there?
Yeah, earnings miss expectations and really talking about softness on the earnings call. So AutoZone having its worst day in a number of years at this point, closing at the bottom of the S&P 500. When you look at the results, below expectations pretty much across the board. JP Morgan coming out saying it was worse than expected. When you look at what the print shows, overall, domestic comps on the bearish end of expectations, according to JP Morgan, not accelerating despite some of the inflation trends that people were expecting. So it does seem like do-it-yourself car fixing and buying parts much weaker than anticipated. The stock now only up 9% on the year, and really when you look at it, it had been a stellar stock for quite some time, but it does seem like a number of those trends that were driving strong sales and driving consumers, whether it was inflation needing to fix cars or simply looking to save some money and not buy a more expensive product, we are seeing that show up on both the top and bottom line. And again, really across the board, softer than most analysts were expecting. And it does seem like some of those concerns, whether it's from a macro or micro perspective, are starting to bubble up.
Okay, let's get to Campbell's because it beat sales estimates. But tell me about the details here.
Yeah, when you look at these sales estimates, top level, it looks pretty good. But digging underneath that, it does seem like, at least according to analysts, a number of that was driven by retailers trying to buy ahead. So when you actually look at it, it was worse than most were expecting. When you look at the commentary from the management team on earnings, they were talking about weakness they're seeing in snacks. So thinking about products like Goldfish, weakness across some of the portfolio as well. It does seem like a rough time for the company. And the really interesting thing is, as you can see, it's been doing nothing but moving down and to the right, closing at the lowest level since 2009. So this has been a big loser in the S&P 500, a big loser for a number of indexes that it's in. It does seem like as those prices are rising for more expensive goods, consumers are buying private brands. So if you're at Target or Walmart or your local grocery store, you're actually buying the brand that they're manufacturing as opposed to paying up for Campbell products. And it does also seem like the impact of tariffs is starting to bubble up. So you're being hit, if you're Campbell, from not only higher prices being pushed onto consumers, you're dealing with people downshifting their spending and your own products getting more expensive. So a number of headwinds at risk for the company. Interesting thing was a couple analysts saying that fiscal year 27 will end up being the trough. So it doesn't seem like many are bullish on Campbell's again after it closes at the lowest level since 2009.
Yeah, it is interesting how long it is taking some of those tariffs to actually be passed on to consumers, but there it is. Okay, JP Morgan dropped the bank's warning of higher than expected costs here.
Yeah, bigger costs. This came after management was speaking at a Goldman Sachs conference. So that headline number well above what Wall Street was looking for, even higher as it relates to cost than the highest expectation for the sell side. They did talk about maybe more modest demand or modest fees, from banking. It did seem like talking back the fact that they're going to deal with, as they put it, inflation costs. So I don't know if that means paying bankers more money or something else on the back end, but it does seem like a more cautious outlook. Again, this is the worst day for JP Morgan, which has been a pretty stellar stock recently, in about 9 months. So you are seeing some jitters showing up. We also saw management kind of talking about at least a little more cautious on the consumer. So continuing to strike a less optimistic tone. Again, when you pair that with what we saw from Campbell's as well as AutoZone, it is certainly a precarious situation for the consumer seemingly here in the U.S. and maybe globally.
Bloomberg's Bailey Lipschultz with the latest out of New York. Thanks for that, Bailey. So Microsoft will invest another $7.5 million to build out AI infrastructure in Canada. Let's start there with Jack Manley, global market strategist for JP Morgan Asset Management. Thanks for joining us today.
Yeah, of course. It's great to be here. Thank you.
So Microsoft has made a few of these announcements recently around the world. Does it make strategic sense to make this kind of investment in Canada on their end?
I think it does make strategic sense on Microsoft's part. I think it's also good news for the broader Canadian equity market, broader Canadian economy. You know, when we have conversations about technological revolutions like the ones that perhaps we are in right now, the way we typically see market leadership evolve over these revolutions is it moves from what's referred to as the makers, the guys that are actually building the infrastructure, to what's referred to as the takers, the guys that are using that infrastructure to revolutionize whatever particular business model they may be pursuing. We're very clearly in that maker phase. What we don't talk a lot about is the taker phase. And by building out more of this infrastructure in countries like Canada, you are giving Canadian enterprises the opportunity to become that next big taker. A lot of benefits from AI without necessarily the enormous amount of capex that companies in the Magnificent Seven, those hyperscalers in particular, have had to pump into this story. So I would say good news.
Okay, so let's talk about a couple of things, because Canada is looking for control over its own data. It looks like this will help along those lines. But at the heart, you have a company that is based somewhere else. So will it truly give Canada control over its data?
I can't speak to whether or not it gives Canada control over its data. That I don't have enough insight into to be able to speak to it authoritatively. But I do think that allowing Canada to increase its adoption of artificial intelligence, right now, latest I saw says that it ranks somewhere within the top 20, but it's not within the top 10. That I think would be overall good news from an economic perspective, especially when you're talking about an economy that's been somewhat sluggish and looks set to continue to be sluggish as we move through 26.
Okay. As you, I'm sure, have heard, Donald Trump now says it's okay for NVIDIA to sell those H200 chips to China. What changed?
Yeah. Yeah, well, so, when I think about what's going on geopolitically, especially as it relates to tariffs, very clearly China and the U.S. are engaged in a 21st century space race, right? When you look at what the U.S. has to offer, the United States has a lock on the highest quality, highest technology semiconductors in the business. When you look at what China has to offer, they have a lock on the world's supply of rare earth materials, which are going to be critical for building out a lot of technology infrastructure, those chips included. We see that each country wants what the other guy has, right? And what we've seen recently is that China has been using access to rare earth minerals as a bargaining chip for this trade war that the United States is waging with them, and in trying to leverage greater access to these high technology, high capacity semiconductors. To me, this feels like the next step in a broader negotiation where the United States is offering high quality chips, not the highest quality chips, but high quality chips, almost an olive branch saying, okay, we gave you this, now you give us something in return. Let's not ratchet up these tensions any further, spook markets. That's how I'd interpret it.
Does it, however, put the U.S. at risk in the AI race?
I don't think so, at least not giving these chips to China. The bigger risk in the AI race is that China is able to develop their own technology homegrown. As of right now, it's not there, but very clearly they are looking for it. And if you remember earlier this year, DeepSeek, huge headline, Chinese artificial intelligence company announcing that it was able to build large language models with similar complexity and capacity to their U.S. counterparts, but not using U.S.-made chips and, frankly, doing it for a whole lot less money. Remember, it sent jitters through markets. It was a broadside against technology names, major pullback at the start of the year. We might see something like that happen in 2026 if China were to announce another breakthrough on the AI front as it relates, again, to their homegrown capabilities of building out those highest quality chips.
All right. Talk to me about how you expect the markets to end the year.
Yes, I'm reasonably confident as to where this market goes. When it comes to the United States, we are a hair's breadth away from 7,000 on the S&P, and barring any big surprises, and one of those big surprises could be tomorrow with the Fed's meeting, but I'm not looking for it. Barring any big surprises, I see no reason why this market can continue to melt higher and hit that 7,000 target by year end. When I think about 2026, though, what worries me a little bit is that even if the market does get up to 7,000, entirely possible, there is still a deep concentration problem with the Magnificent Seven accounting for the lion's share of those returns and a very significant valuation problem. These markets are trading at levels we haven't seen since .com. I don't think it's a bubble, Morella. I wouldn't go that far as to call this a bubble, but I do think you still have a market that next year will be susceptible to some of these shocks, like those headlines like DeepSeek that I mentioned earlier. So, yeah, we grind higher. I think I'm constructive on where the market's going through the end of the year. I'm frankly even constructive on where we go next year, but it's not going to be a smooth journey. There will be a lot of bumps along the way.
Okay, so many people have had concerns about valuations. Are you moving towards stocks with lower valuations at this point?
I'm not overtly concerned with valuations. When I think about why you're buying the Magnificent Seven, nobody is buying these names, or really any name that is tied to the AI revolution, for the earnings that they're going to kick out over the next 12 months, for the dividends that they might be paying over the next 4 quarters. That's not why you own these companies. You own these companies because you expect they're going from $5 trillion in market capitalization to $10 trillion in market capitalization over the next several years, and it's going to make you a lot of money along the way. Looking at forward price to earnings ratios, where those earnings are next 12-month metrics, it doesn't tell you the whole story. So to me, valuations are important. It's not the be-all, end-all when it comes to investing in technology, artificial intelligence in particular. That said, there are a lot of names out there that are going to be trading at much more reasonable valuations, sectors that'll be trading at much more reasonable valuations, things like financials, perhaps materials, industrials to some extent. All of these could present interesting opportunities in 2026 for those investors that are looking to diversify away beyond just the Mag 7 and own a little bit more of a U.S. equity market where we're expecting to see earnings growth participation broaden out.
All right, Jack Manley, got to leave it there, sir. Thanks for your time. Jack is global market strategist, J.P. Morgan Asset Management. Coming up, NVIDIA shares down today, even after the approval from the White House to start selling H200 chips to China. More in a moment. Welcome back. Let's take a quick look at the markets as we ended the closing day and see where we landed. The TSX did gain today 74 points, about 0.2%. The S&P 500 didn't change materially today. It dropped 6 points. The Nasdaq today gaining 30 points, so up 0.13%. As everyone waits for decisions tomorrow from the central banks, the U.S. Federal Reserve expected to cut the key lending rate, and the Bank of Canada expected to hold, with some strength both in the job market and for GDP growth in this country. The U.S. president has approved NVIDIA's sale of the H200 chip to China, a decision some national security hawks argue will allow Beijing to leapfrog forward in AI development. Let's go to Jay Goldberg, senior analyst at Seaport Research Partners, to talk about this. Jay, thanks for your time.
Hi, thanks for having me.
So NVIDIA shares got a bit of a boost on the news initially before coming back down again today. We saw the same thing happen for its latest earnings report. What does that tell you?
I think there's a lot of ambivalence about this. There are on the one hand, there's the commercial side of NVIDIA would like to sell into China. It's a major market, and they've been cut out of that and lost a lot of share as a result. So financially, I think investors would like to see them being able to sell into China. On the sort of geopolitical side, there's still a lot of uncertainty about the details of the deal and under what terms they can actually sell. They're selling an older product, the H200 from last year, not the latest Blackwell systems or next year's Vera Rubin. And so there's a lot of uncertainty around it. And I think that gives us some cause for concern about how sustainable is this? Will they be able to sell next generation of chips? What's the delay? Will this actually be meaningful to the results of the longer term?
Okay, so these chips amount to about, $5 billion US in sales to China a quarter, apparently, if it was unrestricted. Is it also worthwhile for NVIDIA to carry on with this, considering it's up and down, depending on Washington on any given day, as well as now a U.S. surcharge they have to pay?
So I think from a strategic standpoint, there's a very strong need for NVIDIA to be able to sell into China. The longer that they're absent from the market, the more room that gives to domestic Chinese competitors to come up with a solution and build that into commercial viability. This is a great opportunity for those kinds of companies to sell, and companies like Cambricom and also not least Huawei to sort of get a foothold in the market and to grow on that. And NVIDIA's absence from the market is a sort of pretty serious strategic threat. Again, China is the second largest AI market by most metrics, and so their absence there gives a big window for their competitors to grow there and then potentially over the long term expand outside of China.
Have other domestic companies in China been able to compete? Have they been able to fill that void? You mentioned Huawei is one.
I think that most people would agree that the domestic Chinese solutions are okay, but they're not really competitive. They're not even close to being competitive with the latest Blackwell chips from NVIDIA. I think most domestic Chinese customers, their internet companies, would really like to have access to Blackwell, but they can't, and so they'll use, necessity is the mother of invention, and so they'll make do with what they have. There's different demand directives there. There's the government plays a role here, and I think Chinese customers would, like to have Blackwell, but if they can't get it, they'll find a way to use something else and make that work.
Does sending the chips to China pose a national security risk to the U.S.? That's the concern many have been talking about.
Yeah, that's a tricky one for me. I mean, I'm not a national security expert. I think there are some legitimate concerns. There are certainly some legitimate concerns that AI chips from NVIDIA will end up being used by the People's Liberation Army, in ways that might threaten U.S. or Canadian national security. But I also think that those entities can get access to Blackwell through other means, can get access to NVIDIA offshore through shell companies or whatnot. And probably what ends up happening here is that Chinese AI labs, Chinese AI customers for sort of commercial and consumer use, they're the ones who are going to get cut off the most.
Yeah.
So I tend to downplay those concerns, but I acknowledge that they're real.
Yeah, it's interesting because you have mixed messages, right? You have Washington saying, yes, you can sell these chips, but then you have justice sort of cracking down on smuggling operations to get some of those chips to China. You have a sell rating on NVIDIA. Why is that?
I'm concerned about NVIDIA's growing need to subsidize or discount their products. Like, this is something I've been highlighting a lot lately in my notes, is they're effectively discounting their products. They don't call them discounts. They don't show up in the income statement, but they're giving rebates. They're doing backstops. They're buying capacity from their customers. So they're taking payment in kind rather than in cash. There are lots of little things that NVIDIA is doing to sort of make it easier and for those customers to buy their products. And you have to wonder why, if there's so much demand for AI, like everybody says, why is NVIDIA having to discount? I think it points to some slackening of demand and also a growing competitive threat from companies like AMD and Google.
So how long would you say that's been going on?
It's been going on for a while. It has taken a big step upward in the last 6 months. And we saw that in their latest quarter, their backstop commitments have doubled. And we've certainly seen Google come on very strong with their TPU. It just makes me wonder, like, how sustainable is this demand? And, sort of a bigger picture, I'm also worried that NVIDIA's numbers are so large. In order for them to keep this momentum, every subsequent quarter has to be bigger. And we're just getting to the point where a lot of their customers are sort of stretching their finances to be able to afford these ever-growing systems. So I think it just sort of points to a slowing growth outlook for NVIDIA, certainly in the near to medium term.
Interesting. All right, Jay, I'm going to leave it there, but appreciate you joining us on the program. Thank you.
Thank you.
After a break, Microsoft unveiled its intention to invest a lot of money in Canada. We'll have that in a moment. We're watching shares today of Microsoft after the company announced it's going to invest more than $7.5 billion in Canada over the next couple of years. Let's talk to Tyler Radke about this. He's a global software analyst at Citi. Thanks for joining us today.
Yeah, good afternoon.
So we know that Microsoft has been making these large announcements in different countries around the world. Does it make sense for Microsoft to make this investment in Canada?
Yeah, I mean, I think, as you said, you've seen this roll out globally. We saw big announcements, obviously, in the U.S., in the UK, other major developing countries around the world. When you're spending, close to $100 billion of capex, there's a lot to go around in terms of standing up data centers, and obviously, you're talking about some of the largest economies. So I just kind of view this as consistent with their global approach. It's the biggest software company in the world and serves kind of the highest number of customers. So putting the resources to meet their customers where they are.
Okay, so talk to me about what this actually means, because they want to expand data centers, which is something you referred to. What else could this mean for Canada with this $7.5 billion investment?
Yeah, I mean, I wouldn't read too much into it other than this is aligned with Microsoft's strategy of building out the capacity where they are seeing the demand. I mean, you saw a massive bookings quarter for Microsoft last quarter, hundreds of $billions of new deals that they booked, and obviously have to now go out and build that capacity to deliver on things like the OpenAI API service. Obviously, you're also seeing a lot of strength from kind of the traditional cloud workload. So, big blue chip companies from traditional industries are still, in the early to mid stages of moving from their own data centers into a hyperscaler like Microsoft or an AWS. So I think it's sort of a reflection of that trend in the industry as well.
Okay, Microsoft mentions that it is putting in $19 billion of investment in the country, sort of in the longer period, and then the $7.5 billion part of that. What does it mean moving forward for Microsoft? Is it likely that they're going to do more hiring in Canada as a result?
Yeah, I haven't seen anything specific on the hiring front. I would just say the investments are largely capital expenditures, which is going out and buying the equipment to put in the data centers. Obviously, when you do that, you do have to, people have to do that, right? They have to design and build these data centers, operate them, et cetera, right? So I imagine there will be, certainly jobs and things created, but certainly haven't seen anything specific as it relates to their hiring plans.
They're also talking about a threat intelligence hub in Canada. What could that look like?
Yeah, so if you think about Microsoft, under the surface is actually close to a $30 billion cybersecurity business, which is, I think kind of people lose track of that with all the talk around AI and cloud infrastructure. So that's exactly that, right? If you think about their broad cybersecurity portfolio, there are a lot of resources and a lot of investments going into that, ensuring that whether it's securing all the agents that the customers are building, things like Microsoft 365, your email, all that internal and external communication, those are things that they're focused on securing.
All right. Tyler, I will leave it there. Appreciate your time. Tyler Radke is Global Software Analyst at Citi. Air Transat canceling some flights for today and tomorrow. It has yet to reach an agreement with its pilots who have served a strike notice. We'll update you on the state of negotiations when we come back. Less than 24 hours now until pilots could walk out at Air Canada, Air Transat, and they've yet to reach an agreement with the pilots union. So they're canceling a second wave of flights scheduled for today and tomorrow. CTV's Scott Hirsch has more on that.
There are signs of progress in negotiations. We've heard that from both sides, both the airline and the union, yet no major breakthrough as of now, meaning yet another day of concern and frustration potentially and uncertainty for travelers looking to get away on vacation. Both sides have indicated small steps in trying to reach a deal, and according to the airline, improved offers were made last night and negotiations continue today. But cancellations must now begin to prepare for the potential of a work stoppage tomorrow. The two sides remain at the table in Montreal. They've been negotiating for nearly a year at this point and now under a strike deadline less than 24 hours away. Air Transat has said it has offered its pilots wage increases upwards of 59% over 5 years, a number the union is pushing back on, saying that specific figure is not on the table, calling it creative accounting. I have gotten some clarity from the airline on that number, specifically in an email saying it represents the average increase per scale for the entire group, meaning less for some and potentially more for others, but it says it is standing by its numbers, however, saying the figures can change at the bargaining table as new offers are made. The union says it's also pushing for increased job security, benefits, pension, as well as dealing with scheduling and safety issues. Now, on the operational side, passengers will now start to feel the impact of a looming strike as Air Transat has announced the initial cancellation of several flights, and it could get to a full cancellation by the end of day today, as the 72-hour strike notice deadline is technically 3 a.m. on Wednesday. So any customers facing a cancellation will be notified by email from the airline. Of course, the best advice for all passengers is to check the status of flights before heading to the airport. The airline says it is attempting to offer passengers more flexibility in rebooking if traveling between now and this Friday. But right now, as it stands, in terms of flights, several flights have been canceled and more are likely to be canceled if there's no breakthrough in negotiations by the end of day today, as the looming strike is set for tomorrow, meaning these pilots could walk off the job first thing tomorrow morning. Back to you.
CTV Scott Hurst reporting. As Bombardier showcased its newest jet, the company CEO says he hasn't checked the math on Saab's claim its fighter jets would bring about 10,000 jobs to Canada. CTV's Omar Sachedina has more on that.
Canadian superstar Tom Cochrane headlined the entry into service kickoff for Bombardier's Global 8000, an $83 million U.S. business jet the Canadian company is banking on to become a superstar in the sky.
So this is the fastest airplane that exists on Earth right now, built here in Toronto. We should be very proud of that.
In an exclusive one-on-one with CTV News, Bombardier CEO Éric Martel says the jets have become its bread and butter, propelling its remarkable turnaround for a company that nearly a decade ago received hundreds of millions in government bailout for its C-Series passenger planes, which failed because of cost overruns and technical delays. Now it's extending its reach into defense to build on its success.
Perhaps Bombardier's dreams are greater than its ability to pay for them. You, of course, want a piece of the pie from these billions in government commitments that we saw in the last budget. What do you say to those critics that you're extending your hand too far?
This is a very fair question. And this is something that I think we learned from what happened in the past. It's not like we're designing a jet fighter or something else. We won't do that. But it's what we're doing is we're taking, the existing platform, and we are helping people to integrate their system. The risk for us is very minimal.
The latest potential move is to deepen its 15-year relationship with Saab, which is trying to sell Ottawa on its Gripen fighter jets. The Swedish company says Bombardier would assemble the planes in Canada, creating up to 10,000 jobs.
Which would effectively be doubling your Canadian workforce, because currently you have 12,200. I mean, is that a realistic number?
Yeah, I think when they say 10,000, they probably also look at the whole maintenance after and support and service. The reality is those planes will be built. We'll need X thousands of people probably to build it with the supply chain.
So the number, is it realistic or is it?
I don't know. I haven't checked their number, but they came up. But I'm assuming that it's also including the all aftermarket and support for the next 30 years.
So these 10,000 jobs are not necessarily direct jobs. They could be indirect jobs. Do you think it'll happen?
I don't know. I'm not in the secret in Ottawa, so I know some people are thinking about this very seriously right now.
But obviously, it would be a substantial plus for your company to have this decision be made in Saab's favor. So you could join with them or pair with them.
Absolutely. So we could be, as I said, we've been a partner for a long time.
For now, the primary focus: business jets. Last month, the Canadian government removed a 10% luxury tax on private jets, which is helping. So is the fact that aerospace is mostly exempt from Trump's tariffs.
Actually, it was free trade since 1979, even before NAFTA, and even, of course, before USMCA. So it's a bit of a global agreement that, country can do aerospace parts to other country, and there will be no tariffs.
But as there is talk of USMCA being revisited or reviewed next July, is there concern that perhaps aerospace could be included?
There's always
tariffs?
concern.
Especially for a jet like the Global 8000, which includes parts and assembly from Canada, Mexico, and the United States.
I'm always thinking of Plan B, Plan C, Plan D, but the reality is, as I said earlier, I think common sense will prevail.
Despite the headwinds, for today at least, Bombardier is celebrating. A Canadian plane sold to a Canadian buyer. Billionaire and waste management mogul Patrick Dovigi.
CTV's Omar Sachedina there. The Bank of Canada is scheduled to announce key interest rate tomorrow. Many believe they will hold. We will talk about that in just a moment. The Bank of Canada is set to make a decision on rates tomorrow, which many believe they will hold steady. Our next guest says they anticipate a dramatic hit to the economy in the coming months. Let's go to Pedro Antunes, Chief Economist at the Conference Board of Canada. Pedro, thanks for joining us today. Why do you think the Canadian economy has escaped a wider and more dramatic hit this year from tariffs?
Well, I think we're, in fact, still seeing the repercussions of this tariff war on the U.S. economy, and that will have an impact on Canada's economy. We're not so negative on Canada's economy overall. We do think we've kind of gotten through the worst of these initial tariff hikes and the squeeze to our exports. But going forward, we are expecting a fairly weak economy for Canada and fairly weak employment growth, although in the last few months that has picked up quite strongly.
Yeah, you expect some of the drama to be played out next year. Why is that?
Well, I think we still are seeing a situation where there's so much uncertainty around where will we settle on tariffs. Nothing's resolved yet. We know that the CUSMA renegotiations are due next year. They'll probably start sometime in the fall. So we're more hopeful for 2027 to see a bit of a recovery, assuming that we have settled on something that allows businesses, some certainty around where the tariffs will land.
But because of the stronger GDP number that came in, as well as the strength in jobs, you don't anticipate a cut tomorrow?
No, I think it's pretty clear the bank will hold steady for now. In fact, we not only did we get a revised third quarter estimate from Statistics Canada, we essentially got much stronger growth over the last 2 years, so 2023, 2024. And that's an important factor for the Bank of Canada because they're essentially looking at where is the output gap. So, essentially that's a percent over 2 years that really closes the output gap. And I think the bank will, and of course, we're seeing the labor market tighten up. The unemployment rate just fell dramatically to 6.5%, and wage growth is still strong. So all of these things suggest that the bank will hold pat. If we do get something drastic or more dramatic on the economy, then perhaps the bank will have some firepower here to lower further. But for now, I think we're pretty much going to see standing pat.
Okay. What will you be listening for in the remarks from the governor?
Well, I think we always look for that directive around where things might be headed. Certainly the bank, I think their position will be that they're more or less at neutral, that the economy has been in line with expectations. Obviously, they'll have to refer back to the stronger than expected growth that we have. But going forward, I do assume that they'll see their inflation projections in line with where the economy is headed. So I think essentially they're going to position themselves with the rates staying at the current levels.
Let's turn to the U.S. for a moment. A decision expected there tomorrow as well, most expecting a 25-point cut. Do you see clear reasons for a cut?
Yeah, well, the U.S. economy, first of all, the Federal Reserve has a different directive. They are also concerned not just about inflation, but about the labor market. We know in the U.S. the labor market has been weak. It's certainly the economic growth overall has been holding up. But if you look at what's going on, it's essentially the tech sector and these investments in AI and data centers that have been essentially masking the impact on consumers and on underlying inflation. So because of the labor market impacts here, I do think we'll possibly see another rate cut in the U.S. And remember, the U.S. has not cut nearly as much as we have seen in Canada. So they're not anywhere near their neutral rate, which they consider at about 3.2, if I'm not mistaken.
Let's talk for a moment about the independence of the Federal Reserve, because, of course, Jerome Powell will finish his term in May. How concerned are you about that? And what is the prognosis for something like that if we don't get a reserve chair who is as independent as Jerome Powell? What's the fallout of that?
Yeah, I think we're all very worried about independence of the central bank, and this has been an ongoing issue in the States, in some other jurisdictions, but in Canada as well. We have heard in recent years some of the politicians getting involved in central bank policy, and I have to say vice versa as well. We have seen the governor also getting involved in some of the policies that federal and provincial governments have done. I think it's important to keep that independence, to focus on what they're supposed to be focused on. In the U.S., we're very concerned. I think what will keep things in check is bond markets. Bond markets will, show their disfavor if we start to see policy directions that is not in line with the economic conditions and with the inflation numbers. So we're hopeful that that will be the check on the system in the U.S., regardless of who takes on that role next year.
All right, Pedro, I'm going to leave it there. Appreciate your time. Pedro Antunes is chief economist at the Conference Board of Canada. Coming up, hot picks. We'll look at the replays in the commodity sector when we come back. Time now for Hot Picks, and we zeroed in on 3 plays in commodities with Taylor McKenna, analyst at Copernic Global Investors. We kick things off with his first pick, K+S.
They're a potash producer, and the reason why we like it is if we look at potash, right now it's trading well below the incentive price, around $330 a ton. To increase the supply, to build new mines, you're going to need a price well above $500 a ton. And as long-term investors, if we look out 5 years or so, you'll be in a shortfall. So there will be new mines that need to be built. Prices will have to rise. And in that environment, K+S has a very good mine in Canada and then some middle to higher cost mines in Germany. But with those middle to higher cost mines, they have incredible optionality to these likely higher prices in the future. They also have a very strong balance sheet, so they can weather this storm that they're in right now. So we see a lot of upside in the future.
Actually, maybe we could put up a quick one-year chart for Nutrien. You probably saw that story that U.S. President Donald Trump mused about putting tariffs on Canadian fertilizers, but he's been going to and fro. He issued an executive order just a while ago to cut tariffs on imports of Canadian potash. And so he's been cutting them now. He's apparently talking about increasing them again. I see the Nutrien investors are taking the news in stride.
Right. We also like Nutrien a lot too. So they have incredible assets in Canada, very low on the cost curve, very well managed overall throughout this cycle. I think it would be pretty hard to put tariffs on fertilizer from Canada because U.S. farmers rely on this so much.
Right. We're tight for time, and I'm sorry about that. Valterra Platinum Holdings. What draws your attention here, Taylor?
Sure. I was listening to your previous guest, and he was making a lot of good points on the fundamentals continuing for gold into the future. And we agree with that. We still like gold, but we actually see a lot more upside in platinum for some of the same reasons. Historically, it's traded at a 1-to-1 ratio to gold over the long term. It's at a 60% discount to gold right now. You're seeing jewelry demand and investment demand really pick up throughout this summer and into this fall. So there's a lot to like there when you compare it to gold, at least historically. Importantly, on the supply side, it's always important to look at the supply side when you're investing in these metals. The supply side is pretty dire at current prices. So you'll need much higher prices for reinvestment to occur in the core market of production, with its South Africa likely north of $2,000 an ounce, and we're here around $1,500. Getting back to the company Valterra Platinum has incredible assets, some of the best assets in the world. They're in South Africa. They're the largest platinum producer in the world. They have a very good management team and a strong balance sheet. So they're doing okay at current prices, but if prices rise, that would foster new investment, which is likely to happen. They have incredible optionality like K+S.
And then finally, Glencore, a giant name in metals.
Sure. Glencore we view it as a sum of the parts nature. They have an underappreciated copper portfolio in our mind. They bought in some great assets, some brownfield assets over the years. And as everyone wants more copper, they're going to be increasing production over the next 5 or 10 years, particularly in Argentina. They also have one of the best coal portfolios in the world. Some of those assets are in Canada that they bought for Teck at a very, very good price. We're going to need coal for a while longer, especially these met coal assets in Canada. And then, of course, they have the trading business, which gives them solid cash flows and allows them to buy back stock at depressed value. So we see from some of the parts value a very good opportunity in Glencore right now.
And of course, we're almost out of time, but major shakeup in the metal market with it. Looks like Anglo American is going to get Teck Resources. Of course, the votes have still to be counted.
Yes, it does. It does seem that way, and it looks like the company will be headquartered in Canada. There's some very good assets within Teck, but Glencore surely got some great coal assets very cheaply.
Taylor McKenna there, analyst at Copernic Global Investors. Just a reminder, tomorrow we get the last Bank of Canada rate announcement for the year. Canada had a surprise positive GDP move recently and has had strength in the labor market that moved the unemployment rate down. So based on both of those, the bank is expected to hold the key lending rate. Many, of course, though, will want to hear what the bank governor has to say about expectations for 2026. And then the U.S. Federal Reserve also announces tomorrow Most there are anticipating a rate cut of 25 basis points with weaker jobs numbers in the U.S. and still some sticky inflation concerns. That does it for the close. Thanks for joining us. We'll see you back here tomorrow.